Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, April 9th, 2025. It is 11 o'clock a.m. Eastern Time as I'm starting the video right on the button. I am going to cover in this order. I'm going to talk a little bit about the equity markets, talk about where we may go from here, kind of give you thoughts on my trading plan and things to consider right now in the market, of course. And then I'm going to go into just briefly, it's related to the market. I want to cover financials, both bank and non-bank financials, including private equity sector, and then treasury bonds. And this kind of all goes together. So I made a few comments this morning, a couple replies to yesterday's post. There were some questions there, gave you my thoughts. Let me just start out with the macro, kind of the bigger picture, fundamental outlook. Every bear market and every correction is different, but a lot have some similarities. This one is about as different as any I've seen. One thing about this one is it's brought on. Obviously, it was technically induced. This is exactly what I've been calling for. Charts have been predicting for a while. This, and I always say there's typically a fundamental catalyst, and that is the trade wars, that will then be the trigger for a technical breakdown. In other words, you first put in the divergent highs, you went into a trading range, and then broke down. And nothing's changed. Trump campaigned on, and if we know anything about him, he does what he says. That's what makes him different from other politicians. He's a very atypical politician, and so the whole trade war should be no surprise to anybody. But they are. Market ignored it, shrugged it off, and there'll be a change. Right now, I gave an analogy on the home page in one of those questions. It's the world's two largest economies. Again, the two biggest economies in the world, China and the U.S. In my view, are playing a game of chicken. They're driving the cars at each other 100 miles an hour, and if neither or both don't veer off, they're going to have a head-on collision, and the results will be outright catastrophic. That means cars crash, meaning the stock market and their financial system. Remember, Apple, you might think, okay, well, Apple, big company, it's big tech company, but it's not going to change the world. Yes, when Apple, for example, if it continues to fall, Microsoft, in the markets in general, everything's going down with them. As I always said, kill the leaders to kill the market. The financial system, as we know, it will break. And that's a very real risk right now. What do I mean by that? Well, the financials and non-financials. I'm talking a big hedge fund. I'm talking a pension fund. Pension funds are one thing I've been calling for years. Not a right-away call, but something in the foreseeable future. In the next few years, you're going to hear about it. You're going to hear about it soon. CalPERS, for example, the largest public pension fund in the country, I believe in the world, possibly, is been grossly underfunded, as most and the majority of U.S. pension funds. For those not familiar with those are, that's a pension fund, be it public or private, puts money away and you give guaranteed benefits to the workers in retirement. The private sectors all but phased those out because they're just not sustainable. They were losing their ass, so that's when the advent of 401ks came about. They shifted the burden of retirement onto the consumer. Here, we'll match, we'll give you a 401k, you can put your money away, we'll even match some of that, and you're responsible. If you blow up your retirement, it's on you, not us. If you mismanage or there's, it's hard to navigate the financial markets. So, but pension funds, which the public sector still has, puts some money away and guarantees a set amount of retirement for the rest of your life. That's a pension. And it's called a defined benefit plan. And again, those have been phased out largely in the private sector because the private sector is more efficient. So, in theory, I'm all for Doge. Like I told you before, I even have a brother-in-law who's works in the Department of Education, pretty high up, and he's, for the concept of it. It sucks right now. Poor guy's losing weight. It's ugly to be in. But the government is fat. I don't want to go too much on that. And that also goes to show with these, they still have the great pension plans as well, the federal government. And so what you're going to see, and the amount, guys, is staggering, the amount of money in these private, in public pension funds. And I don't. It's not a guess. It's a fact. I can't see their current returns. They only publish those periodically, typically quarterly. But I can tell you, CalPERS is incurring massive losses because the thing about this came on fast. I have zero doubt that they weren't able to pivot and get out in front and things like that. So there's two components to this, and I address this in the comment section. You can read a little bit more about it. When you have a fast market drop like this, it's a function of two things: time, magnitude, the scope, how swift it is, and price. One thing I said there is that 401ks, you have two type of investors out there saving for retirement. You have, in this day and age, more and more folks that have their iPhones and they're checking every 5 seconds on what their balance are every day, every night, or online on the computer. And then you have the majority, I think it's still the majority, that just open their statements or paper statements. Some bury their head in the sand, especially times like this. That's just a common trait of investors. They won't even open the statements. They watch the nightly news. They know what's going on. But those statements come out quarterly. 401k plans will typically generate quarterly statements. Even brokerage accounts will generate quarterly statements unless there's activity for the month. So if you have a Fidelity account, your brokerage account, you're going to get a statement every 3 months. If you make a trade or withdrawal or anything, move money around, you get it at the end of the month. That's how statements typically work in the brokerage industry. So where I'm going with that is, and I made this example, COVID, for example, it was by every metric a bear market in the S&P 500, which dropped 36%, but it was in 6 weeks. And so literally, if you blinked, you missed it. And if you held tight and didn't, open your quarterly statement, you didn't know. You just went through a bear market that you never saw because your December 31st balance was the last time you looked, and your next statement kicked out through March 31st, the next 3 months out. You got that early April, and again, depending on the timing of it, you know what I'm talking about. That thing was over within a quarterly period. You were back to, you can see my crosshairs, 3.5 months. So from the peak, 3.5 months later, we're already back above that level. And so these are the components here, and and not only that. So there is that. That's the biggest, one of the biggest things right there. Consumer spending accounts for over 2/3, roughly about 70% of GDP, meaning the government can stimulate all they want, spend. Problem is the government's tapped out right now. We know that. That's one of the reasons that the Trump administration is doing Doge, even though it's a pimple on an elephant's ass. The bloat in the government. It's a start, what they're going to get done. So I'll applaud them for that. Again, let's not get into the political aspect of it. The concept and the theory, I believe, and I think a lot of people, unless you're in it or don't understand the importance of finally getting government spending and reining it in, get it under control, it'll be catastrophic to the U.S. Ultimately, it'll be the demise of this country. We know that history shows we cannot continue at the trajectory we're at with spending, deficit spending, especially if interest rates get out of control. I'm going to cover that in this video, guys. That's a big one. Remember, I predicted the other day there's the risk that they may start selling treasuries. We started to see that. Told you I shorted treasuries the other day, although I did cover. We've continued to see that it was a profitable trade, but they continue to drop, yields going up. That is, other countries are getting tired of Trump's BS. He's alienating everybody in this, allies and friend and foe alike. So anyway, that's not a good thing. It's a very, very bad thing. We'll watch that. Again, I'm going to give you things to monitor. We're going to look at the non-bank financials. On the markets, let me just start there. This is... I keep talking about the RR not being favorable, skewed to the upside right now. I believe that it's a very flexible call, but all it takes right now is, what is a tweet? 280 characters or less. It can take as little as 280 characters typed out on a tweet that would cause such an explosive short covering rally. If you were short, it would literally probably tear the skin off your face. It would be so bad. We'd shoot up. The market would be up, 10% in a matter of, within an hour. It's possible. Again, if the ideal tweet came out, something positive on the trade war front. And again, as I started out, the two largest economies in the world are playing that game of chicken. So if they don't veer off, what happens is both of the financial systems start to break. So this drop here, and I'm going to expand on that a little when I get to the financials. This drop if it's quick and resolved and the markets do this, again, I have every metric. I have a bear market started. I'm not looking for new highs. I'm open to that possibility because anything's always possible. I'll let the charts dictate that as we go. But if we continue without this and we go down or we stay here, let's say it's prolonged and the markets go on down here, the longer you're there, the greater chance of folks that may not be looking at their statements daily or are and feeling the pain, don't know what to do. The farther you go down and the longer you stay down, the greater impact it has on consumer spending. Okay, that's an easy concept to understand. So far, this has been relatively swift, just like COVID. COVID was over before you knew it because of the stimulus and the reversal in the market. So therefore, consumer sentiment came back, and the government overstimulated. Again, it's like the person walking into the ER with a head cold, and the doctor, they give them 5 boluses or whatever the amount is of epinephrine, which is adrenaline, inject them with a heavy dose. That guy is going to jump off the gurney and fly and crawl on the ceiling like The Exorcist, right? That's what the government did here with their stimulus. They didn't need to do that much. They overreacted, and then you got this what I think we'll be paying for a long time. Excessive valuations, excessive risk taking. Crypto went crazy. Meme stocks went crazy. Everything went crazy. AI bubble. It was all kind of result what started back here, and then keeping the pedal on the metal with the zero rate. So where am I going with that? Okay, so but the point was that once you did recover, then it kind of set, and there was a lot of growth, and again, a lot of people didn't have the time to even react, and so consumer spending kept going, of course, with excessive stimulus as well. That's why you had that just powerful, super strong bull run after that. So that is a real possibility here, and to me, it's not a matter of if, it's when they're going to resolve this. This could be kind of an ongoing tip back and forth thing going forward on the trade wars. And again, let's just talk U.S. and China now, being the 2 largest, and that's where Trump's really targeting. So just know that and react to it. Now, here's what makes this atypical, this whole situation. Very atypical, different from any point in time. You have Trump and China. Both. But because of his rhetoric, he has boxed them in. China, typically, and I know I'm not trying to, this is not the same as Japan. China and Japan are two completely different countries, but you have that Asian, that kind of saving face thing, the pride thing. Trump has boxed them in the corner, given them no outs with his rhetoric. And so they now have no choice. They can't look weak. They can't count down. They can't even give an inch. He's pretty much shut off the potential. It says he doesn't want to negotiate. That's it. And they've said we're not going to yield an inch, and they don't want to look weak. He has had that rhetoric which is just, it doesn't make sense. We all know his strategy. It's like if you go to buy a car. Let's not talk when you bought a car when COVID hit and everything was above MSRP. Let's talk 99.9% of the time you buy a car or a house. The car is $40,000 MSRP, or the sticker price. I'm sorry. You look up the KBB, and it's you can buy that car for $35,000, and so that's where you start. You offer 32, and the dealer's salesman's gonna come back at 38, right? And then and you're gonna come in and buy the car at 36 or whatever. You're gonna find your price. That's negotiation. Trump's not giving that option right now. That's typical negotiation 101, and by again using such strong rhetoric, it's almost as if he's forcing, and he knows yes, we all know, you've heard the headlines recently, China buys a lot more of our crap than we buy, we buy a lot more of their crap than they buy ours. So we, in that sense, we have the upper hand, but it's mutual destruction. It's a zero-sum game. And again, he hasn't given them a lot of opportunity to negotiate. It will happen. I think it'll happen in little steps. First thing he'll do is probably give Apple the pass on tariffs, and for some time being, you can continue to make X amount of your iPhones in China. That'll be the first step, and that'll send Apple through the roof, and then that'll send the stock market through the roof. That's one of many things out there. I think a very real possibility. So we'll watch this, see what happens there. I am, I'm since, I keep talking about the RR. That's all I can do, guys. This is we're in uncharted waters. Again, every bear market, everything's different. This one could be over again as quick as a single tweet. Probably going to be, it'll be this. I have little doubt. You'll get a rally, whether we go to T4 first, and we're going to zigzag down as we always do. That's why I list multiple targets. Now, the funny thing is, if you anybody that's followed me and listens to a lot of the videos I do, and probably no less than a dozen times, if not several dozen times, since I started calling for the top back here, laying out for some market top ranges when I laid out all these targets back here, and we hit that. And again, we went marginally higher, put in that trading range right above it, then fell back down. In multiple instances, I said because we already hit T1, 2, my read on the charts, it was that we would go because we already hit, and again, had to do with my read on the charts, that we would most likely come down through T1 and T2 and even T3 with little to no reaction, and then go straight to T4, even though T3 hadn't been hit. Again, this is here, again, over a dozen times in videos. So I'm very much open to that now. Why I've kind of morphed my trading plan, because we kind of got there so quick, the near-term selling climax and all that. So initially my trading plan, and I told you multiple times, was to just get short, stay short, and even in the trading account. Long-term accounts, I'm still swinging for the fences, but I made some shifts there. I even told you I moved money recently, and I'm small, about a quarter 401k money, long-term money to the bounce, and I'll continue to add down here. We get to T4, that's a really nice level. Unless what I'm going to cover in this video, it would be a generational, a lifetime thing, but with the system could break. I don't think it's going to break. I think they'll fix it. They'll do whatever it takes to not break the system. But I'm going to show you what to watch for. Things that they're not probably talking about on bubble TVs right now. Things that you can watch for that may indicate things are starting to break. So we're going to get to that in here in a second. So I just wanted to say that was for many months now my primary scenario, that once we started next leg down and got the longer term sell signals I was looking for, I think I said even once the 200s are taken out, it'd be a relatively swift move down with little, if any, reaction on T3, even though it hadn't been hit down to T4. So I'm open to that. However, we have, as I mentioned, the recent, you can't see the volume bars, two big, huge bars. The most oversold reading on the weekly chart that we've had since the last bear market in 2009. We have not been this oversold, 26 on the RSI weekly. I believe since back here, we might have hit it there. That was a low. The RSI was 28.51 at that trough right there in the last, and I consider this a correction. This was an orderly, we gamed this bear market. You can call it a bear market with near impunity. It was easier to trade because it was more on a slower rollout. This was a response to the rising rates and inflationary environment. Right now, this is a news-driven market. A single tweet, a single headline. We've had a couple false headlines break hit, causing rallies the other day. This market is so hyper-focused on news. I cannot emphasize that enough. So be careful. And look, there's a lot of uncertainty, more than even I like to see in a bear market because of that. Because it's driven by the whim of the whims, if you will, or the actions of Trump and China largely right now. But all right, let's get to the other levels. So nothing's changed since yesterday. I got a post out to you this morning. We had a brief, as I told you, very brief and a quick recovery back. It's not a hard line. These are solid breaks above. This is our trading range recently. And right now we have seller fatigue. We had not only no good news today, but we actually had worse news. China again upped the tariffs on the U.S. That was the latest news, but you had no reaction. Now, sentiment is as ephemeral as the spring rains right now. We saw that yesterday, right? One of the biggest, wow, the record books, yesterday's reversal. I mean, they talked about the reversal and from how much we were up in the markets to the reversal set records going back decades. And so we are in a very untypical, very atypical, very fast moving market. So again, the takeaway is, keep it light or stand aside. We don't have, what I can tell you, we don't have a textbook bottom right now. at all. We are at my third price target on the weekly chart. That is good support. There's better support down here at T4, and that is the next support. If we get there, I'll give you my thoughts. If we get there soon, if we get there this week, we're going to be even deeper oversold. But I've always said, and I'll continue to say, oversold is a condition that is typically followed by a significant reversal, but it is not a bottom. And in bear markets, oversold, the one thing I've always said, it tends to become deeper oversold or stay oversold for an extended period of time. So buy signals that's why I give you the long-term kind of outlook where we're at, and then I give you the short-term. Buy signals or pops above each of these resistance levels. This is the same chart I gave you yesterday. Where do we stop today? This is the open right here. Well, we stopped exactly at that first level. 1, 2, 3 60-minute candles. Got to pull back. And so it's very simple in my book, barring any other crazy new stuff. We pop 424. We go up to 428.84-ish. We pop that. We go up here. And ultimately, we pop that. That's probably going to be on news. And you have my upside targets. That's still what I'm leaning towards. I made that clear last couple days. We just need to do it. And it's incremental, one thing at a time. You're not going to pop 430, 424 without popping 424. You get it? Each one increases the odds the next one will get taken out. Likewise, I cannot rule out a sudden swoon down to that next target. To try to quantify it for you guys, about 6% from where we opened today. Let me go back to my weekly, my bad. Weekly chart. Okay, where we opened the T3. T3 is at 413. I've had it at 412.99, so I just leave it there. I don't want to move the levels that've been there since last year. 6.5% if from the 413 level, to give you an idea of the downside. So the RR, I continue to maintain this. I'm beating a dead horse here, but it bears repeating. I think it's skewed to the upside, meaning I see about at most 6% downside if there's another big swoon down versus a potentially explosive rally that could be about 15% or so up to about this level here. And so, that's 2 to 1, 2 units upside should good news happen and we break out and rally up there. We also have that near-term seller fatigue. It could be a temporary thing or it could be a little bit more lasting. We'll see. All right, let me get away from this. Let me just hit SPY real quick before I do. SPY, these were the long-term targets I also gave you last year, have not been modified or changed. We hit T3 almost perfectly the other day. I always cover a little bit above the level 480. So you have both the S&P 500 and NASDAQ 100 at my third targets, but I also have deeper targets, and then we're not there yet. And I think, like I've said repeatedly, the fact that we've had so many check marks only increases the odds. It's just a matter of I would put the odds at near zero that we're going to go straight there. That's the financial Armageddon scenario I'm getting to now, and I don't think it's going to happen. I just don't think the powers that be will let it happen. China doesn't want it any more than we do, mutually destructive. Mutually destructive, I said, if they don't fix this. Let me just go to PJG. This is a Chinese market here, one of the big ETFs. This was a trade idea that I posted back. I believe it was right here on this breakout. If I'm not mistaken, we hit my first, second, third, and final target there. Made a nice profit on that trade. Managed just well-placed stop. They didn't get that one I talked about the other day. They never clipped that stop. Came close, but didn't do it after hitting T2 and reversing, that is. Hit T3, then put in a divergent high, and look where we are. This is a level I've had here forever and a day. I created that level back on June 9th. I had an update to it, so I don't know if I moved the line. I'm going to put the level up 2413. And why is that level there? You can see there's a big gap here. That was an island cluster bottom. But just a lot of especially most recent reactions there. We had a brief dip down below, but then recovered it. Support, support, support. Support once broken becomes a resistance. Got rejected on the back test and gapped above it. That's bullish. And then pulled back there almost when we, that pullback there. So it's a pretty decent support. Under that, there's only these two. That was in that last bear market there. And this is that big correction we had in 2024. So there's been a few brief and false breaks underneath, followed by recoveries. So it's a good support level. And so there it is. China and the U.S. are at support. And remember, they both have a lot to lose. The leadership in China has a lot to lose. The leadership in the U.S. Congress will step in. They're behind Trump now because he had the momentum going, but they can reverse the trade tariffs. So either way, that's it. Hopefully that all makes sense to you guys. Is that things will get fixed, and if they don't, they crash. That's a real possibility, but not my probability. Okay, I had to pause the video there. Took a phone call at one quite a bit. It was probably a 10-15 minute call. So if you see any differential in the time's always on the bottom left hand corner of the video, by the way, I believe. I used to always have the time counter there. Hopefully it's still there. Sometimes I take software updates to the screen recording software and it may have disappeared. But anywho, okay, so that's it in a nutshell. I think I just showed you China at support, PJG, one of the big Chinese ETFs for the Chinese market. There's also SPY, the S&P 500 at good support as well. What did I do? I toggled over to a daily chart. A decent support, but also, again, third target. And again, by every metric, when I analyze this chart, we are going lower in the coming weeks to months, possibly even years is my belief. But it's all about you don't want to be positioned for where you think the market's going to be a year from now, unless you're a really long-term trader and really willing to ride out some powerful counter trend bounces. But this is that big volume surge. Again, if you look at SPY, very indicative of a potential near-term selling climax. I don't think it's the selling climax at the lows, but that's, I think, one reason. Again, a selling climax, guys, understand how this works. Everything in the stock market, every single stock, commodity, Bitcoin, any security that you trade goes up or down based on supply dynamics, supply and demand dynamics. It's economics 101. If at any point in time you have more buyers than sellers, security will go up. And if you have more sellers than buyers, it'll go down. So what happens is, even though the news is, again, not only not gotten better today, it's actually gotten worse. The market's not responding to that. It's not going down. And again, that may be very fleeting, and we could continue lower. We could break that support. Thing about buying climaxes is you can definitively identify them in hindsight. You can potentially identify them in real time based on these things, but there's no limit here. There's nothing to say that we can't go down. Volume can't increase, even if it doesn't increase. That's not a must either. In other words, we speak again. I speak in probabilities, not possibilities. It's certainly possible to go down, hit my next targets when I go out to the weekly chart. If we do go down, I showed you already on QQQ, and then SPY, we have the next target here, T4 at 466.81. So let me get away from that, and go on to some of the other things I want to cover. So this isn't already going to be it's looking like a long video already, and I'm gonna bring it home here. XLF, I happen to be on a weekly, so I'm going to show you this. These are kind of weekly long-term targets here. First target / support zone. Why is that? You can see it was this consolidation range here, all-time highs back here. That was really the top of the basing pattern right here, the sideways trading range with one false breakout above. So that's defined as a target zone. When I say support or target zone, it means I have two levels in relative close proximity. So we can either reverse here down to there. Anything much below that, you break the support zone and you're likely to go down to the next one. So we've hit the top of the support zone. I always put a higher weighting on the most recent reactions. You can see the reaction highs there, but again, this was a trading range there, so we could anywhere from here to here. Another way for me to say it, I see the most likely downside potential is limited to about another 3.5% in XLF, the financials. So they are very good support. I would be surprised, not shocked, but surprised if we just went straight through there, did not pass go, did not collect 200 or whatever it is, monopoly, and went down to my next target zone. So this is what I favor. Maybe all the way back to the 200s, maybe not, and then up some point down here, another rally, and then ultimately down here. That is where I see us going in the coming months, sometime probably the end of this year or early next year to get down all the way there, and that's going to be we'll be in a full-blown recession when that happens with the financials down there. That's about all the guarantee I can give you if we get down to the last target zone. And on the daily chart, Here we're at XLF. Remember, this is a financial sector ETF. This is all encompassing. It has the banks, the big banks, such as JP Morgan, the largest, the 800-pound gorilla in the sector, has non-bank financials. It has Visa, MasterCard. You have Berkshire in there. So you get it, insurance companies, banks, and holding companies like that. And there it is. We're at that 42, 43 support right here on the daily chart. And you can see this meshes with that target zone on the weekly from right here down to about right here. There's that trading range there. There's the highs back in 2021, 2022, that trading range. We broke to the downside. I give you, I guess, 3 targets there. Actually, it was a long term back there. I stuck with it, and we hit the final target there and went a hair lower to put in that divergent low, mark the bottom. Here was the divergent high, sell signal 1, breakdown and back test, sell signal 2, breakdown and back test. Then the 200s went nothing but check marks on the bearish front. But again, we're very oversold. This is the deepest oversold reading we've been since. You just put a line where we're at now. This is the RSI there, about 2190. Last time we were that oversold was right here. Did you want to short the financials there, or did you want to cover your short and or go long? I think you'd want to go long. Time before that, we were oversold here and here, and that also marked that bottom. So again, probabilities, folks. Just not objective to start shorting right here, even if we can go down. But again, I see it limited to that. Anything beyond that means the system has crashed. Get your guns, get your bunker ready, get your MREs. That's meals ready to eat and military stuff. Bunker food, and that's what's going to happen. I don't think that's going to happen, guys. I really don't. But if it does, that's if the financials do that, things are breaking, and we're going to go over that in this video. Things to watch to break. Let's start here. We're on the financials. The biggest 800-pound gorilla in the room is, of course, as I said, JP Morgan at $603.7 billion right now, market cap, the largest financial. You had what I just noticed now, looks here, Head and Shoulders. Somebody may have mentioned that on the site, I don't know. But I've seen quite a few other Head and Shoulders. This is what we call a Head and Shoulders pattern. That's left shoulder, LS. I'm trying to draw it in their head. And the right shoulder. Look those up if you're not familiar with them. They consist of those parts, and this is what we call the neckline. Defines the bottom. There's your sell signal breakdown. We back tested the neckline. The measured target, to take very simple. You take the widest part from the head down to the neckline. I'm just measuring distance wise right there. Add that to where it breaks down, and that gives you what we call the measured target of the pattern. When I have a measured target that falls between 2 of my support levels, I'll typically give it the benefit of the doubt and say that that's where we're probably going to go. But we could certainly go down there. You can see it kind of splits the difference between 2 of my support levels on JP Morgan. So I don't think the move is over unless it gets back above that. I favor the measured target being closely met or fully met or down to here. What would change the technical posture of this stock? A recovery back above the neckline, which would also be, coincidentally or not, recovery back above the 200-day moving averages, which right now are pinching together, the 200 simple and exponential. And then there's a gap there. So each of these would be big red marks, if you will, or check marks for the bullish case and red marks against the bearish case. To see us get back solidly above there, especially this level, and then we take that out, we're probably going to new highs because something else is happening that I'm not seeing in the charts right now. I don't think that's the case, but anything's possible. Maximum would be a bounce up the back test. This is a primary uptrend line. Here, let me color it in for you. I know this is what I call a busy chart. I have a lot of levels from back here. I haven't cleaned this chart up. There's JP Morgan. That's the primary uptrend line off the October 2023 lows right there. We already back tested it once, so we really should have no business back testing it again. Like I said, that's where we're at. I'm not going to cover each and every one. Let me do this for you. Let me show the big sectors I'm watching. And what I do is I also watch, and I'm doing this on a daily basis, for any red flags, things that the folks on TV aren't picking up that might tell me something's breaking. Remember, I've said this recently. Warren Buffett's quoted as saying, when the tide goes out, you see who was swimming naked. We saw that in the financial crisis that uncovered Bernie Madoff's largest Ponzi scheme in history. During the last last one was really, I still maintain, a correction. It was orderly. The drop in 2022, but call it whatever you want, technically a definition bear market. That's when the regional banks blew up. They all would have failed, just about all of them. The first was Silicon Valley Bank, and then we had a couple others. So you had 2 of the 5 largest bank failures in history, and then the Fed came in and backstopped the rest of them, or we would have saw almost the entire regional banking system collapse. Why? Because most people didn't know. I didn't know this. The imbeciles that were running the risk management department, and they were marking, they had treasuries with huge embedded losses. I've talked about it quite a bit. And they were marking them to maturity, even though they weren't. They needed that money. So the banks were technically insolvent due to their losses on long-term treasury positions when rates started going up. So I don't know where the next bomb lies, but I promise you, after years of excesses in the market, extreme excesses created primarily by the Fed, also by the federal government, but primarily by the Fed, with excessive low money, easy money, artificially low interest rates, there are bombs hidden. And some of those bombs might be the known ones, like I talked about, like a big hedge fund or a pension fund or a broker dealer blowing up. So we're going to watch this. And what you do if you have this or a similar charting platform, sort every day. I look by the percentage gainers or losers. Are there any outside losers? Bank of America right now is the biggest in the entire sector down, but it's coming up to support. Okay, so I watch this every day, and if I see something, especially day after, I noticed a couple days before, I see a chart in free fall that stands out from the rest, right? Birds of a feather flock together. Most of the big banks should be moving down more or less in line with each other. Now, Bank of America is coming up to great support. You want a trade op? Buy Bank of America right now. Buy it down to here. I'll just go out and say it. I think it's an objective long. The system either breaks, and Bank of America has some kind of embedded losses that that this is causing because they were caught off sides. They gamed the stock market. There's Bank of America. Back in the financial crisis, they would have went down. They all would have went down if the government didn't bail them out. So Bank of America is in free fall right now, but it's coming up on great support. So it's one of those kind of Hail Mary. It's either going to reverse here or down to around this level. This is really good support. This is as oversold as you've seen this stock in years, right here, since back there and then back here. And you can see what happened then. So either the world is going to hell in a handbasket and Bank of America is doing this, or something good is going to come out soon and this stock is going to explode. And I don't think it would. I don't think it would blink till it came back up here at about 36.84. So your RR is, you're going to make 11, 12%, and you're going to risk about 4 to do it, something like that. That's a nice RR. Or you don't, or not, guys. It's a catching a falling knife trade. You try to catch falling knives. Sometimes you get a few cuts, or even your fingers cut off or your hand cut off. Be careful with that. I don't advise anybody to do anything. I'm just telling you this is an objective level. But it's also a red flag. What's going on with Bank of America? Why is this stock, one of the world's largest banks, down 31% in a matter of just a couple months here? But coming up on support, again, I have no little doubt there's stuff going on. They've got big positions underwater, big losses right now, as long as something doesn't break. And, down the line, you can look at them all. CFG at support. I'm just looking at today's losers, Wells Fargo. Let me cover a couple other sectors, the ones I'm watching. The regionals, of course, KRE. Regional banks, highlighted this as a big, potential reversal candlestick there. Breakdown, back test here, breakdown there of both the primary uptrend line 200 days, highlighted that as an objective short, and this one's just been falling. This is a really good support level down here. So they're kind of in no man's land between support and resistance. There's a little bit of support there. If I look closely, I do see levels. I don't want to force it. But again, I'm more concerned which regionals might be in trouble. So again, you can see today FFWM First Foundation is coming in towards its multi-year lows right here, but it's at support right now. Just one to watch. Big divergence. everything's going to explode higher, especially these depressed ones if there's some good news coming soon, which I'll probably be, is my opinion. Is doom and gloom as I am long term. Not doom and gloom, just looking for a nice, beautiful, long term secular bear market that, if I'm correct, it's going to be a field day to trade long and short. Zions Bank, down big today at support. But again, all the ones that are down big at support, guys, I'm starting to get pretty excited on the long side here. Yes, me, the guy calling for the big 50% drop when we were at all-time highs recently, but a lot of stuff at support. Can it break? Yes, and if it does, all hell in a handbasket's coming, right? There's the next support, then the next support there. These are support levels I think Zion is going to hit. It's just a matter of, are we going to bounce first or not before we get down there. So I'm watching this. I don't see anything. The ones that are down the most today are coming up on big support. Again, there's no guarantee that support will hold. There's some stocks I've had charts on recently that came to really good support with a quote unquote, with my little air quotes right now, you can't see my fingers doing that, should have bounced, but they didn't. They just went right through there. So you got to be careful here. The other sector I'm watching besides this, IAI, the broker dealers. This is one I highlighted here, sell signal there. We've had this downtrend line that keep getting rejected on. Let's extend that out a little further. Took out the 200-day moving average, hit them, bounced back to resistance, then took the 200 out there. You had nice support at 134, gap down below it, and we're at this 120.87 target / support now. The next supports you can see right there and there. So we'll watch this one. They can cause systemic instability as well if a big broker dealer fails. The ones that you can see right now, LPLA, coming down pretty hard, but coming up on really nice support. So a little bit of downside there. This thing could jog down about another, from where it's at, about another 4%. It should hit some pretty nice support where it, quote unquote, should bounce. But again, guys, I do this video because if it doesn't, something's going wrong, and this guy can go bust. And any one broker dealer going bust can have a cascading effect on the financial system. B. Riley, lights out for this one. I highlighted that recently. This thing's headed down to, I mean, look where it is. Oh, what's going on with B. Riley? If you have money in this with this company, you might want to be concerned. It's down 97% off the highs. Probably going to be bankrupt. I can't, I'd be careful with that one. This one, I have a little support right here. This is TradeWeb, one of the last holdouts. And then boom, down 21% in less than a week. At support now, you can see the different targets there. Here's one. Here's why I marked this up today. There's a great example. This is Lazard. LAZ is the ticker. Divergent high. There was your sell signal. So far, that thing has dropped about 42% from the breakdown point. And here's an example where you had pretty good support right there. You also have a reaction low right there. You had positive divergence, and it just gapped down through it. Instead of bouncing, boom, something's going on with this company. That doesn't look good. That's an unhealthy chart. Be careful with this one and watch it, because again, I don't know. You can get on Yahoo Finance or whatever source you want. That's a good source for reading about what a company does, what could be their exposure, what kind of, what are they doing? Some of these guys have different business models. MC, bear flag, beautiful. Bearish rising wedge. Boy, the charts are just playing out so well. That was a bearish rising wedge. Bear flag, there's your flagpole, bear flag, boom, right down to support right there. About hit its measured target. So here's another one that, quote, unquote, should bounce here. If it doesn't, what's going on? Things are getting really ugly and the financial system's going to start to break. That's it. So, this one just broke down, BGC Group. Again, I'm just going through today's, and here's the ones that are bouncing today. Robinhood at support, DFN down below. Ooh, big positive divergence. But again, I've just showed you an instance, and we've seen quite a few. I've highlighted some divergence lows lately on the intraday charts, but I talked about that. Intraday divergences, bullish setups, just get snowplowed. They're bull fodder in a bear market, bait for bulls. And that's what's showing me the character of this market. We keep plowing through these divergences, taken out support levels where the buyers, quote unquote, should be stepping in. But again, it's a little bit different market. It's not 2022. It's way different. That one just kind of organically went down. We bounced where we should have bounced when we should have bounced. This is different. You have, again, almost unprecedented with the two world's biggest economies playing that game of chicken, like I said, driving 100 miles an hour at each other. And if neither of them veers, meaning cows down and make some concessions, or both, those cars are going to collide, meaning their stock markets, and then the financial system goes, because it's not all about bloated, overvalued tech AI stocks. It's about the banks, the financial system, the gears, you know, the cog, that you get a wrench thrown in the gears and the whole financial system starts to break. And then you get a 1929 like crash situation. Not 87 was a technical glitch, you know, one day 23% drop Black Monday, but then the market was closed up positive by the end of the year. That was more of a different thing. 1929 would be closer to what this would be if, and I talked about it recently, you know, in their infinite wisdom. It started with Glass-Steagall, I'm sorry, repeal of the Glass-Steagall Act, which was set in place after the crash of 29 and the Great Depression, where the banks were gaming the stock market. That's why the banks failed, contributing to the Great Depression and the crash, you know, horrible bear market back then. And in their infinite wisdom, they repealed that. And I've already spoke on that. That was back in the 90s. And more recently, I saw relaxed regulations on crypto for banks. So, you know, we're kind of, you know, setting the stage for a lot of that stuff. But again, it's not what I favor right now, guys. I don't think it's going to happen. I think they'll step in. Cooler heads will prevail soon, even if you've kind of got a egomaniac driving the ship right now up in DC that is just coming in with a sledgehammer instead of a scalpel, trying to, you know, negotiate a trade deal here. DFIN. All right, I'm not going to do each and every one. Let me just cover the other ones I'm looking at. So I covered the broker dealers, regional banks, BKX, I'm sorry, is the banking sector ETF, just banks. If you want to strip out, you know, XLF has non-bank financials at support, but also kind of cracking that support. It's okay support. Next support down here. And again, you can look at different financial companies. But the other one I wanted to look at, PSP. I've been calling for this for a while. Big bubble in private equity. Huge beneficiary of the Fed's extended zero rate policies. You have also big in recent years, public pension funds such as CalPERS have shifted a lot more money into private equity away from traditional assets. Private equity is imploding, as they should be, because they were, you know, with free money, it's not hard. When you can borrow it next to zero rates, you can turn around and they've been cutting the fat on so many businesses for so long. There's not a lot more fat to cut. You know, private equity, they go in, they've been doing it to hospital systems, they've been doing it to nursing homes and everything. Everywhere they go, they come in. It's kind of like the you know, corporate raiders. Anywho, their gig is up. I mean, it was technically induced. Divergent high, breakdown, back test, boom. This is that was the ETF PSP. Here's the individuals, the biggest. Let me go by market cap. Let me just do that. Blackstone's the biggest breakdown. You know, Blackstone's down 41%, but at good support. Here's a common theme, guys. And again, I'm beating a dead horse, but that's why I do all these videos. A lot of financials are at or very near support. Support levels where I would put favorable odds that we're going to bounce, but it's going to take something to change, and we need to see some positive news to get a real bounce. Anything more than just a temporary, you know, bounce, hold that support, and then break. If we break and continue to break, other things are going to break besides just this. Remember, this is the financial sector. Tech can go down. It was overvalued. It does. When it corrects, it goes down. Most tech stocks drop 50% or more in a bear market, and that's normal, and they don't go away. Apple's done it many times in the past. Alphabet, Meta, all of them have dropped 50% or more. Tesla, that's just kind of the norm, and they get back. And but the banks, guys, the tech sector has a bigger impact on the stock market. It's a bigger weighting. But the banks are what keeps the grease, you know, the gears turning in the U.S. and world economy. So that's why I'm doing this video, showing you levels to watch. You can replicate these charts, set alerts. And again, watch, you know, for any any outliers, any that are falling more than the others, especially if it's something you might have money with, a regional bank or a brokerage firm. At that point, you might want to get your money out. I'm not going to digress and go into the difference of FDIC insurance and SIPC, Securities Investors Protection Corp, which brokerage companies have, but it's not the same as FDIC, far from it. And then you have private insurance additional through most brokers, but you don't want to be in a failed brokerage firm. So watch the charts of your broker. For example, IBKR, Interactive Brokers, Schwab, they're all public. Most of them are publicly traded, and there's Interactive Brokers at really good support. That's a target I've had since October 15th of 2024. You can see we just hit it. Charts are playing out beautifully, but boy, it's a quick move down. Took out that first target there, 157.21. There was the breakdown right there. And we just hit the next support level. We're well below the 200-day moving averages. If, more so to me, when 128.69 goes, then that opens the door to my next target, which is 106.78. And that's just a healthy correction, bear market, whatever you want to call it. So where did I start becoming concerned? Well, there's a primary uptrend line I'll just add right now. That starts to get taken out, but more so if that gets taken out and the rest of the broker dealers are doing okay, then there's a problem with Interactive Brokers. And at that point, I may start moving some or all my money out, make sure it's protected. Right now, you got to trade somewhere, and that's just one Schwab, SCHW, and there it is. SCW. SCHW right there. Boom. That's support. Divergent eye right there. This is, this one. Let's see if we have an uptrend line to watch. Yeah, there's a primary uptrend line right there. So we'll want to watch that. These are also targets before this bear market's said and done. At minimum, we'll probably hit these targets. And then if we hit this one soon, whether it's right now, 61, soon within the next week or so, $61 plus the primary uptrend line, especially if you can get a divergent low or something. But we're also at support now. So the way it works, if this support goes, takes us down to the next level, about 61, then you have a primary uptrend line. No bueno if that goes, and then each of these levels below. And that's probably why the red line there, that's the lights out number for Schwab if that happens, 45. All right, let me wrap it up here. You get the takeaway. Oh, and then Treasuries, as I mentioned recently, I said what we're doing here, Trump is just ticking off everybody, and it can't afford to do that right now because foreign countries own a lot of our bonds, and he's just about insulted everybody in the book, including a lot of our allies. And so I told you the other day, because of this level here, I shorted Treasuries. I did cover on the trend line, like I told you. And you can see this is a outsized move. So what was happening before, when the market was dropping, you were getting a flight to safety bid. Where's the stock market right now? It's at the recent lows. So you would think that they're still buying Treasuries flight to safety. No, but the other thing happened. China, we're pissing them off. We're pissing other countries off. They're selling U.S. Treasuries. This will crush us. So Trump is so confident he has the upper hand because we buy a lot more of the other countries' stuff, not just China, than they buy ours. So in that logic, yes. But they also hold a lot of our Treasuries, and they can punish us, and other investors can if they don't think that we got a madman at the helm and they start selling U.S. Treasuries. We're fucked. I'm sorry to say it, bluntly like that. This country is fucked because we cannot. We already have we're already a budget deficit right now, and if our interest expense continues to go up, that's what happens when bonds go down. It's because rates are going up, and it's something I've been predicting for a long time. I believe we're in a new secular bull market of rates, and meaning falling bond prices, rising yields, and that's where I think we're going over time. So this is no surprise to me. If it gets worse, however, we could really be into trouble, some trouble, because our interest expense starts going way up, and that only adds to our deficit. No matter how much money they cut, and Doge cuts fat out of the federal government, again, it's going to be, like I said earlier, a pimple on an elephant's ass. It's not going to move the needle compared to the amount of our debt load. This is a 10-year bond spiking up. Plunging down recently after the flight to safety bid, and then boom, why, you would think if, with the stock market being at its multi-week, multi-year lows right now, that Treasury bonds would still have that flight to safety, but something else is happening here. That's something I said to watch out for as a red flag. That is a red flag, my friends, right there. And so if it continues, if it ends here, okay, we might be okay. Just, again, something to continue to monitor. That's what I do in these videos day in, day out. That's why they're long-winded, because there are a lot of moving parts of the market. I'm probably one of the most dynamic. I use fundamental and technical analysis, and I watch just about everything. I just did an almost hour-long video here, and this is just a fraction of the things that I'm watching to try to glean clues into what's going to happen next. But again, there's that spike in yields was indicated by that divergent low at support right there, and that's it. So now, what happens if the stock market rallies? You would expect normally yields to go up, because they usually go up when the stock market rallies, but we've already had the up, so I don't see right now. I'm staying out of the trade on treasuries for this point in time, because if the stock market rallies, you get a flight to safety bid, and normally that would actually bring yields up on prices down, but we've already had a big run up, so I'm just standing aside this one and kind of just watching it right now to see what happens in the treasury markets. In credit spread. Remember, I tell you, I watch credit spreads very closely, and let me change my tool color here. Something that stands out. Let's do red. They have been, as expected, spiking up, but they're not really running away yet. So I'm watching that, so you can see where they're at. We've certainly had an uptick. So the credit markets aren't as worried. They're expecting a resolve of this, and I've said this many times in the past. The smartest folks out there, typically bond traders, they tend to be a lot smarter. There's so many individual investors in the stock market, so that's the and how many, can I say this? Go to a cocktail party. How many people are you talking about? The 10-year Treasury bond or credit spreads versus talking about crypto, Bitcoin, Nvidia, the usual suspects. So the retail crowd is all in stocks. They're all in the stock market. They make irrational decisions. They buy when they should be selling. They sell when they should be buying. Smart money watches the credit markets. Now, HYG, one of the two big high-yield junk bond ETFs, did just break support. That is a red flag. That means you're seeing, credit spreads continue to widen here, and if they don't recover that level, that's not good. I also watch JNK. Junk is coming up on support now. That's the other high-yield junk bond fund ETF, and then FALN is one that I watch as well. That one's in free fall right now. So continue to watch the credit markets. You watch these. Credit spreads are what junk bonds are paying relative to treasury bonds. Both have been falling lately, and so that's keeping credit spreads kind of on par, but I've just showed you a minute ago the uptick. All right, I've thrown a lot out at you. Your head's probably spinning, but at the end of the day, we can guess all day long what the next tweet or news headline on the trade wars is going to be. And again, if you're faster than the computers, you can maybe act on it when you get it. But by the time you read it, you're going to first see the movement in the market, be it up or down. So all I'm trying to say is the best thing I've always learned, you let the charts be your guide, not the news headlines. You're driving in the rearview mirror if you're trying to. Your trading plan is to act on the latest tweet or headline on CNBC or wherever, Wall Street Journal. That's it right now, guys. We remain in that trading range right here. Good news. Any good news will most likely, in my opinion, cause nothing short of what I would refer to as an explosive short covering rally, whereas bad news has been largely priced in, at least for the time being. We had more bad news today, and the market opened exactly where it closed yesterday. So we're getting that seller exhaustion. We're getting down to support. So in summary, I'm going to say what I've been saying. The RR, that doesn't guarantee where we're going. It just means the RR to me is skewed to the upside, favors the upside versus downside right now. Again, that doesn't... I already talked all hour long about the potential for a crash. I don't put it as the most likely scenario, but it is a possibility at this time. It's a lot more a possibility today, infinitely more, almost an unmeasurably higher amount than it was here. I don't talk about market crashes here, and here. If it's going to happen, it happens at points like this. But again, we'll see. Let's see if cooler heads prevail in Washington and Beijing, and they figure this thing out. All right, guys, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it, and I'll try to make the next video a little shorter.